On the investment committee at Shard, clearly fundamental research forms the basis of our recommendations to clients. But there are undoubtedly situations within the smaller company space where opportunities to invest and trade are meaningfully intensified, fueled and maintained by market expectation, and also speculation about a potentially significant outcome. Perhaps the best example of that, whilst we see it in pharmaceutical, we see it in technology, can really be seen within the oil and gas space. A few years ago, the likes of Red Emperor, Tangiers Petroleum and Tower Resources, they all benefited from the imaginations of both retail and institutional investors alike before the oil and gas prices drifted and strategies of that type became ineffective because of a lack of interest. In more recent times though, we've once again been successful for our clients by preempting share price movement ahead of the onset of future drilling campaigns and investing into oil and gas companies. I would say that interest in high-impact oil and gas exploration truly came back in a big way following the drilling success of Pantheon Resources in 2015. Towards the latter stage of that year, the company's share price appreciated eightfold in the space of 3 months. So that certainly captures the imagination of investors. Our strategy with these companies very much depends on the situation. Ordinarily, we'd aim to reduce a client's exposure sufficiently by the point of a well result to enable them to benefit from the potential upside without the risk of financial downside in the event of a failure. The effectiveness of that strategy can really be demonstrated by both recent Providence Resources and 88 Energy cases. Clearly there are going to be clients that want to retain their full holding for the drill results, and we can't do anything about that. But generally, we elect to take profits for clients from the initial 12p and 2.3p placings to ensure that they recovered at least their initial outlay whilst retaining some shares for the drill result. Now, in both instances, unfortunately, there have been drilling failures. However, clients are still sitting pretty. We've now got a further turn of the drill bit to come for Providence at Barry Row due to their shrewd financial management of their last drill programme, and all is not lost at 88 either. They plan to install some narrow tubing in the second quarter of next year, so the vast majority of our clients are now relatively relaxed about future outcomes despite there being an obvious drop in share prices. For investors looking to implement this strategy over the next few months, clearly there are going to be opportunities out there. But in the short term, Canadian Overseas Petroleum are planning to drill their Nigerian asset before the end of the year, assuming of course that they secure funding, so that's worth watching. Despite being out of favour with the retail community because of some drilling delays, I really can't see past Anglo-African oil and gas. Recent share price is perhaps a demonstration of the fast money mentality of retail investors currently within AIM. They should announce a rig contract in the next couple of months ahead of the commencement of operations in the latter part of this year to drill both the Mengo and Geno formations, and that should lead once again to a re-rating. Another one that I keep an eye on is Eco Atlantic Oil and Gas. It might be a bit of a slower burner by comparison, but they are incredibly well positioned next to Exxon's giant Liza discovery, and I'd hope that they would secure a rig to drill that next year. We'd also expect 3D seismic results, if not towards the latter part of this year, certainly early part of next year, and we may also get some news on the Namibian licences as well, so plenty to happen there.